Hey, this is Matt from InvestiQuant. Today is Friday, May 14, 2021. Yesterday, the markets gapped up at the open and took off to the upside, spending most of the day near the highs of the session. And that was coming on the heels of a 20-day low close. So on Wednesday, we sold off big time. Thursday, we gapped up and pushed higher and closed fairly strong on the session. So what we're going to be looking at today is what has happened historically when you gap up above the prior day following an up day that was on the heels of a 20-day low close. So let's set that up here and discover and see what it has led to historically. I've got all four instruments selected. The setup's based upon entering the market long at the open, which is 9:30 a.m. Eastern Time. The exit is set to the close of regular trading hours, which is 4:15 p.m. Eastern Time. Now, currently, we have been continuing higher in the overnight session. We are trading above yesterday's high. So I'm going to use that for an opening filter here. Open above the prior day high. By definition, that is a gap up, so I don't really need to add that, but I just did to make it obvious up here. That is a gap up above the prior day high. Next, we're going to grab that price pattern that is a day after an up day following a 20-day low close. That pattern is found in the new lows category. I'm going to hit equals here, day after up day following 20-day low close. So this is a 2-day pattern. The first day closes at a 20-day low. The second day is a green day, so it closes above the open after that pattern. So I've got that selected. Next, I'm going to go into the indicators, say we are below a 10 but above a 200-day simple moving average, and now I can hit view results. And here we go. These are the results based upon entering the market long at the open of regular trading hours and exiting at the close, which is 4:15 p.m. Eastern Time. When you open above the prior day high, the prior day was a green candlestick, and the day before that was a 20-day low close. So this has taken place below a 10 but above a 200-day simple moving average. Historically, we've got 37 samples of this pattern in the S&P, 27 in the NASDAQ, 32 in the Dow, and 23 in the Russell. And historically speaking, we've got 59% win rate here on this pattern for the S&P. That means 59% of those have closed above the open or ended up with a green daily candlestick. The NASDAQ, 70%, so quite a bit stronger there. The Dow, 56%, and the Russell, 61%. So all of these at least slightly favored, with the NASDAQ being the strongest at 70%. If we look at the average win and average loss, the average loss is larger than the average win on all four of these instruments. So historically speaking, all four of them have closed above the open more frequently with this pattern that is a bouncing pattern off of the lows. It's had follow through the next day more often than not. But when it does not work, the moves have been larger to the downside than what they have been on the upside when they do work. So hopefully you found that helpful. Good luck today. We'll see you next time.